All right, welcome to a new episode of Yahoo Finance's Opening Bid. I'm Yahoo Finance Executive Editor Brian Sozzi, and I am back in the driver's seat after a trip to Arkansas. More on that in just a few minutes. But I'm also back right after Nike's earnings. Really bad/brutal quarter for Nike. And I'm here to say that this is a company in big trouble, which is hard to say because here's an iconic global company on Nike. We're used to seeing lots of Jordan sales go out the door, but that's not happening. A couple things that caught my attention from this company's quarter, which is why I think they're in big trouble, and it's going to take some time for a turnaround for the company and the stock price. Company pulled its guidance. You never want to see a company Nike size pull their guidance. Essentially, these executives got on that earnings call and said, we're not going to have any guidance for the next 12 months. That's horrible. It's the last thing you want to hear from a Nike. Number two, shocking sales declines. It has been some time since I've hopped onto a Nike earnings calls and heard about double-digit sales declines in key businesses, not just in the U.S., around the world. Most worrisome, really big sales declines online. They're probably the only retailer reporting sales declines online. The rest of them are out of business. And then lastly, too, I think this all sets the stage for layoffs and more cost cuts out of new CEO Elliott Hill. He's about to start in 2 weeks. The company has canceled their mid-November investor day. With any new leader, they first start assessing the business for a few months, and they come in and lay off a lot of people to make those profits look better. They look good, they get their bonus check, and they continue out the door and maybe improve the company. So a couple things to watch on Nike. Tie it all in a bow. I think it's a company in trouble. Let's stay on all things consumer, though. Michelle Meyer is here, Mastercard Economics Institute chief economist. Tell me I got that right.
You got it right.
All right,
that's the title.
I'm running on zero sleep, so it's been a tough few hours. Good to see you.
Good to see you. It's nice to be here.
It's almost holiday season time. That seems to be like when I talk to you most often around holiday seasons. You're out with your latest report. I mean, how good is it going to be? Let's keep things happy and rosy for a minute.
Yeah, well, I think it's actually not so hard to keep things happy and rosy when you look at the economic data. The consumer has been out there engaged and spending throughout this year in an environment where price pressures have been easing. So when we look into the holiday season, we think we'll see just over 3% year-over-year growth, 3.2% year-over-year growth. We're looking at retail sales ex autos from November 1st to December 24th. That window of time actually is probably somewhat insufficient because, as we noted, the holiday season starts earlier. It's starting now. Promotions are kicking in. We're starting to get into the
Christmas
year.
stores now. What is going
on? I know. Well, the leaves are falling. You got to get into it. And then, of course, throughout October, there's a lot of push around the holiday season. But I do think it's going to be an interesting to watch the composition of the consumer basket into the holiday season. My sense is in an environment where interest rates are now falling, price levels have declined for a lot of big ticket durable goods, and maybe the replacement cycle is also kicking in for some of these electronics. I do think we're going to see potentially an acceleration spending on some of these electronics and these gadgets, where technology is moving fast and there could be a need for consumers to re-engage.
I think I'm still using the same computer as the pandemic.
Well, it's time.
It's time.
You can go this holiday season and buy a new one.
So what consumers outside of electronics, where do you see them gravitating towards? Because if they go out and buy these electronics, and they're not cheap, does that pull sales out of other categories?
Of course, I mean, you have to always think about it as a budget, and consumers are trying to best allocate their dollars so that it works for them, their family, and how they want to gift for the holiday season. So some of these are big ticket items, more expensive items, but also remember that these are items that have been price deflating. When you look at the CPI that comes out every month, that's the category that is seeing declines on a year-over-year basis and has been for some time, after, of course, seeing very significant price increases, straightly after the pandemic. So I think consumers are always making choices. That's the reality of the economy. Everything is a decision in terms of how you're allocating your resources.
I was in Arkansas, and I'll bring this up throughout the conversation, walking Sam's Club, warehouse chain, competes with Costco. 85-inch TV for, I think it was $899, like brand new. I mean,
that's a large TV.
That's a large TV, but that's like deflation. Like this stuff is happening. Things are in fact coming down in price.
Yes.
Where else are you seeing prices come down? Because I think there's so much focus, especially this election season, on inflation. Lost in the sauce is that I'm seeing prices start to come down for things outside of electronics.
Yeah, so I think one important point is that there's a difference between inflation and the price level. And that's something that I think gets lost in the conversation. So the rate of the inflation is the rate of change of prices. It's the simplest way to think about it. And we went from a big surge in price growth right after the pandemic to now much more moderate. So headline CPI is running about 2.5%. If you look at some of the core measures, they're fluctuating around that, especially if you take out the shelter component, it's substantially below, like the super core inflation that Fed Chair Powell and other folks like to talk about is maybe even closer to 1.5% inflation. So we have seen a real moderation in terms of the rate of change, but the price level is still elevated for a lot of categories because of such a big shock that happened pre-pandemic. So it depends where you're benchmarking, and this depends how you're kind of calibrating prices. In terms of the categories that are seeing declines on a year-over-year basis, we're seeing it also in furniture, home goods, that
couch.
category.
It's not bad.
All right.
It's just been too expensive for too long.
That's the exact sentiment, right?
So you mentioned lower interest rates. And do you think they are going to be in place? I mean, it just happened by and large.
Yeah.
That this causes an upside surprise to the holiday shopping season. Rates are down a little bit. Maybe things are a little cheaper to put on a Mastercard.
So yeah, the Fed cut by 50 basis points, promised additional easing of monetary policy dependent on, of course, their move towards achieving their dual mandate. So it does seem like we're now on a course towards lower interest rates, and that's what the market is pricing in, which is super important, right? Because it's not just what the Fed is executing, it's what the market expectations are about what comes next. And this pricing in of lower interest rates is quite significant in terms of impacting the rates that businesses and consumers see heading into the holiday season.
Are you in the Larry Fink camp that suggests the market is priced in too many rate cuts?
I think the market is, I mean, if you look at the 2-year Treasury note hovering in the mid 3% range, that's consistent with pricing in somewhere of a terminal rate at the moment, right around 3% or slightly above. That seems pretty fair in terms of how the Fed has been communicating and the possibility that we could have slightly stickier, longer term inflation, or maybe even slightly higher potential growth. So these star variables are highly unknown. It's really unclear where things settle. But I think relative to the prior cycle, certainly the pandemic cycle, but even the financial crisis environment, it's, I think, well appreciated that we're probably going to be in a little bit of a higher rate environment, and we're unlikely to get back to the zero lower bound.
What do you think these rate cuts will mean to economic growth next year?
So, I mean, clearly it's a support for financial conditions, right? So one way that you can look at the impact of rate cuts into the economy is to proxy it through an aggregate of financial conditions, which is going to give you measures of credit spreads, of volatility, of exchange rates, the whole picture. And when you look at these measures of FCI, these financial conditions indices, things are supportive, right? So we're getting into the end of the year with financial conditions that are supportive for overall economic growth. So that can matter in terms of a wealth effect, right? If you have this asset appreciation that has occurred for the past several years in housing.
NVIDIA's stock price. I had to mention. I mean, how can you not mention that? Right?
So if you're lucky enough to have exposure to those, then you probably have experienced some positive wealth effects. Now, obviously, that's not everybody. That's not broad-based, but those are the aggregate figures that are worth monitoring.
There's a whole other debate too that happens out there. Rate cuts suggest the Fed knows something. The economy is slowing down. Like, where do you stand on that?
So I think Powell was very clear in pushing back against that, because you're right, that was something he had to speak to. And the buzz term that he used is recalibration. And I think that is spot on. We've been talking about this normalization in the economy, or the ability to find a new equilibrium in the economy. Monetary policy right now, or where it was prior to the 50 basis point cut, is arguably too tight. Interest rates were too high, given that inflation has made so much progress at coming down. In some of these categories are seeing outright deflation. Given that the labor market has been showing these signs of cooling, it's appropriate to bring interest rates to a level that is more consistent with what they're seeing in terms of the trend for inflation today and where they expect inflation to go tomorrow. So they're making sure that they're kind of getting ahead of it, rather than waiting till there's real cracks in the economy. Let's reduce interest rates so that you continue to push this business cycle along. So I think it's quite prudent.
Do you think we're ever going back to the days of 0% rates? Can I buy a house eventually, Michelle? Tell me about it. I don't have a house. It's still too expensive. Even rates at these levels are still prohibitive.
So, buying a house is not.
I do have a place. I want to say. I do have a place to live. Let me just level set. Okay.
But I don't know. You live in an airport. You're traveling so much.
It's been ridiculous. But.
Yes, I mean, I think certainly if you look at as we talked about, the market's pricing in, we're in a path towards low interest rates across the central bank community globally. So that's the first thing to consider, and that will filter into mortgage rates that are available. But I also think the important thing to know, and I used to say this all the time when I was covering the housing sector in my prior life and when I started out at Bank of America, actually Lehman.
Wait, you started at Lehman?
I did start at Lehman.
Ticker symbol LEH. There we go. A little bit of knowledge there on opening bid.
Yep. And obviously at that time, housing was all that people talked about. So as an economist starting out, studying housing mattered. But one thing that it felt like was always very, very clear to reiterate is that housing is a long-term investment. In fact, it's even more than investment, it's a consumption good. So I think it's really hard, of course, to figure out the right time to do that. But once you feel settled, you're ready to be grounded.
Yeah, I am ready to be grounded.
Right.
What was it like covering housing at Lehman? What was that?
Exciting.
I never asked you about that.
Yeah. It was a lot of learning really fast. Yeah.
Have you used those experiences in the things you cover now? Like things that you don't want to see ever again?
Yeah, well, I mean, I think you have to, one big lesson learned from studying the housing market during that period of time is the broad consensus and operating assumption was incorrect, right? The broad consensus operating assumption is that home prices won't fall nationally, that you can't see, that you just see these regional cycles and that you won't have a broad-based decline in home prices. And that was clearly incorrect, right? And that was realized over time that indeed if you have the environment that we were coming out of, right, with so much excess lending with a small amount of equity down for a lot of homeowners, is I guess one way to put it, you ended up seeing that drop in home prices, which spilled into the broader economy. So lesson learned is always think about both sides. Don't just follow where the consensus is.
Good lesson learned. Hang with us. We're going to go for a quick break. We'll be right back on Opening Bid. All right, welcome back to Opening Bid. We're having a fab chat with Michelle Meyer, Mastercard Economics Institute Chief Economist. We usually see her virtually on Yahoo Finance. Now you're in person, so it's good.
Bright and early.
Bright and early. We appreciate it. So we're dealing really all over the map with this one. Some consumer, some housing, some interest rates. So I just got back from a trip with Walmart's headquarters, got to spend some time with Walmart CEO Doug Millen. Horrible name drop, but I'm just explaining my life and what I've done the past 24 hours. But I think I came away really thinking this is a two-speed economy. You have folks making over $200,000 a year, doing really well, and they're out there spending power on this economy. But now it is $100,000 and less that are really struggling. Is that a fair assessment?
I don't know that you can break it down into just those two categories. I think that what we're seeing across the board with consumers is that increasingly every consumer, every household is making decisions, and they're trying to calibrate their current flow of income, how they feel about their job, how they feel about churn in the workforce and their ability to get a new job if something were to happen to their current job. Looking at their balance sheets in terms of their asset appreciation, which for some folks has been substantial, but also the increase in debt service, along with what's happening around the savings rate, right, in terms of how much buffer is out there. So I don't know that you can necessarily just break it into those two cohorts. I think it's really a function of the industry that you're in and what you're seeing in terms of the labor market.
I always thought making $100,000 was a big deal. I mean, but maybe it's not what it used to be because of inflation.
Well, of course, I mean, the overall economy, everything, wages, asset prices, prices of goods and services, everything inflated from the pandemic. On average, about 20% higher for across the board for those categories, with asset prices sometimes even higher, since 2019. So there has been an upward shock that came from the pandemic, but it was fairly equivalent between wages and core CPI or core PCE. And then I think the other consideration is that, again, it's really a function of your local economy and where you live, the job that you're in, and your own individual preferences.
Some would argue that high interest rates have allowed top earners to leave money in the bank, earn a lot of interest, and they're powering the economy. Do you see that in the data you study?
So we're just looking at the broad data in terms of what the Federal Reserve is showing around household balance sheets. Certainly it is the case if with higher interest rates, you have a greater return on fixed income investments. So it certainly can help. And if you're sitting in a savings account, that also, of course, is beneficial. But I mean, I think that's, again, across the board, to the extent that you're in a checking account or savings account, your money is working a bit more for you in an environment of higher interest rates.
I've loved my CD, Michelle. Like
there you
5% just to stuff money in a CD and forget that it exists. I don't have to worry about studying financial statements and like picking stocks. This is awesome. It's been awesome. It's been life-changing. It's been great. Like, I mean, it's like essentially
easy.
Yeah, it's been easy money.
Easy. But I do think the underlying truth behind monetary policy, that lower interest rates is what's stimulative for the economy, I think that holds true, right? When you think about the ability to see expansion in the economy, a lot of that rests on the ability to borrow and to borrow at attractive rates for consumers and for businesses.
Help us understand this. Why, simple question, but maybe very tough answer. Why is the labor market slowing?
Well, I would argue that it's moderating. I would argue that's finding a better balance. If you look at the JOLT survey that was released yesterday, which is one of my favorite indicators.
Job openings. Yeah, we love it at Yahoo Finance.
Because it tells you not just about openings, it tells you about hire rates, it tells you about quit rates, it tells you about layoffs, and it does so across different sectors. So it's a really nice report in terms of understanding the churn in the workforce. And when you look at that survey, job opening rates have come down. They actually picked a little bit up again, the last report, but they're still above the average prior to the pandemic. So job openings are just no longer at this red hot, crazy high levels. Hirings have basically returned to the average that we had been running at prior to the pandemic. So that's more of a normalization. Similarly with the quit rate, we had very high quit rates in 21 and 22 because of the ability of people to easily find new jobs given how high job openings were. So, and that was creating the inflation push. That was creating a lot of price pressure, and that was what the Fed was looking at when they were hiking interest rates, saying the labor market is red hot. We have to cool this down. And that was part of the intention of higher interest rates. So they're now at a level where things have kind of normalized. So the question is what comes next, of course, right? Is this where we stabilize? Could this be doing the job towards that, again, that nice landing? Or could something be brewing that's more problematic? So we have to watch the data. But my sense is the former, and that's what we're looking at the Economics Institute, is that, you know, in an economy that you're still seeing GDP growth at a healthy clip. Atlanta Fed is tracking about 3% real GDP growth in Q3. You're still seeing investment in labor, investment in capital. It feels as though it's more of that normalization.
What is a good jobs report next year? I think we've been trained.
Next year or on Friday?
Well, let's do both. We'll start.
Okay.
But I think the investors have been trained to think 250,000 plus, good jobs report, things are going in the right direction. But it's no longer over. It's no longer at 200,000. It's slowing down or moderating.
But think about pre-pandemic. If we got 250,000 jobs, it would be like, oh my God, that's a statistical error. Like, how did the BLS report that? Because the belief prior to the pandemic, and that's given the data we had seen in the labor market, trend job growth was probably in the order of 100,000, give or take a few in either direction. So, and that was based off of the path of the labor force and what they were seeing in terms of the dynamics in the economy. So we, in a way, had this period of volatility in the labor market when we went from the extreme amounts of job dislocation when the pandemic hit to this massive rehiring and re-engagement in the workforce. And now we have to settle into something that should be more sustainable and probably more moderate as well.
Do you still put out jobs report estimates? I'm always reading your reports at BofA.
Yeah, I mean, I don't put it out, but I personally.
Oh, so what do you think on Friday? Are we under 200,000 on Friday?
I mean, I think the consensus is probably about right. 150,000.
Okay, that's
I'm going to go with
I had to ask you. I'm trying to like go back into your prior life, but
I know.
So jobs report. I mean, is it the reality that Taylor Swift saves the economy next year? I know you've written about this. Give it to us straight.
Yeah, let's just go to Taylor Swift.
Yeah.
It's always fun.
Yeah.
So I think that what we learned, so we wrote a really fun report, which is what you're referencing, on, we published it quite a while ago now, but it still comes up and it still gets attention, which I love. Thinking about how the Eras Tour in the US created this burst of activity in the locations that she toured in terms of spending on restaurants.
I can't believe I just asked you about this.
I love that you did. Spending on hotels. And it really showed to us, first of all, that it was really cool to be able to isolate exactly that spending in that period of time. So it was just a fun exercise. But beyond that, it showed the ability of consumers to make these choices in terms of how they want to use their purchasing power. And when there's these moments in time where they need to spend, they can and do spend. And that's what we certainly saw from the Swift economy. Going forward, will we have more episodes and moments like that?
Can this continue?
Probably. What they are, I don't know. We're gonna figure it out.
You got the Beyonce economy. I mean, could be something. What about the Travis Kelce economy? I mean, he's right there with Taylor. I mean.
Well, the sports economy is a big one and growing, right? So there's a lot of attention and a lot of activity around sporting events as well that I think in this environment is getting even bigger and more meaningful. So yeah, I think all those things are relevant, right? It's all about going back to the decisions that consumers are making in terms of how they want to allocate their purchasing power. And their purchasing power is largely a function of what happens around the labor market, to the conversation we had before.
Are they still gravitating towards experiences? We've heard so much, they're going on cruises, they want vacations. Or now, I hear you mentioned before, maybe they go out and buy a big screen TV this holiday season. Electronics may do well. Is that about to pivot? You see a change coming up?
So I think when you look at the cycles of spending over the last few years across different categories, the goods category, durable goods, let's call it, right? So it's going to be your appliances, electronics, et cetera, furniture, had a massive increase right after the pandemic as everybody was living at home and had to invest in a digital economy very quickly. When prices surged, as they do because you had both the demand and supply factors leading to higher prices, demand fell very sharply. And now we're coming out of that, I think, given that prices are now back down and we're in a more normalized price level and interest rates should be supportive. The experience economy took longer to recover because they had to wait for the proper reopening and the ability and the comfort of people to go out and travel again. So that pent-up demand was realized a little bit later in the cycle. And that was certainly a big story throughout last year. This summer as well, the experience economy was very much alive and kicking in terms of travel, and particularly U.S. travels abroad, given the strength in the dollar. I think as we look ahead, it's going to be more of a balancing out now, right? I think we're at levels in terms of spending on the experience economy that appear to be, again, a little bit more normal. But it's all of that.
I can't afford to go to these concerts anymore. Ticket prices have gone. I'd rather just buy the big screen TV. I mean, this is out of control.
Well, that's a decision that you were making.
That's good.
With your purchasing power.
It's a fair point.
But everybody is making different decisions depending on how they see the price level and how much they really value that activity.
In the minute that we have left, is there one surprise for the economy that you're concerned about for next year? Something that might surprise investors, markets, et cetera?
Well, going back to what I mentioned before with Lehman, when everybody's so convinced one thing's going to happen, you got to look at the other side. So if you think about what the overall consensus is that it's this continued slowing in growth, that maybe trend growth will come down, some of the productivity gains will slow, et cetera. Well, what if it's a reacceleration in the economy? Because if you look at GDP growth right now, we're running at a healthy clip, right? Close to 3% real GDP growth. We've seen very strong productivity gains. The Fed is now easing monetary policy and cutting rates. What if things reaccelerate and the productivity growth and the investment that has occurred over the last several years really turns out to be continue to be beneficial for the economy into next year in an environment of lower interest rates?
It's a great point. Quick plug for you. Follow Michelle on LinkedIn. I follow her work all the time. Read it, digest it, share it. Michelle Meyer, Mastercard Economics Institute Chief Economist. Thanks for coming in person. We appreciate it. It's always a treat to get some time with you.
Oh, it was so much fun.
Thank you so much. And that's it for the latest episode of Opening Bid.